Welcome back to the TD Ameritrade Network and Fast Market. I'm your host, Tom White, along with my co-host, Kevin Hinks. But let's bring in our next guest for our cash tag segment. It's going to be Landon Swan, the co-founder of LikeFolio. Welcome back to the show, Landon.
Thanks, Tom. Good to see you. Good to see you, Kevin.
All right. So, Landon, car sales were a big item as inflationary pressures kind of took hold. Demand for autos pretty strong in latter stages of 2020. In through 2021, but we've seen a real pullback in a lot of the sales. Maybe a lot of the dealers don't have the inventory, but used car sales are coming down dramatically over the last probably quarter or so. What kind of data are you guys seeing? Because AutoNation's outperformed maybe some of its competitors like CarMax and Carvana, but what kind of data are you guys seeing out of LikeFolio?
Yeah, I mean, if you look at AutoNation's stock chart, it's been kind of in a sideways channel between 100 and 130. I think it's around 110 right now. For the last year or so, it's been kind of sideways. It did have a nice run prior to that, but it hasn't, it's had trouble continuing. And of course, with the markets, it's been pretty volatile. But you're right. I think it has done very well compared to its competitors, Carvana, CarMax. And I think it's kind of a sleeper hit, honestly, because it is the least sexy of the three. Carvana is really cool. It's got the cool thing. CarMax, it's sort of average, but AutoNation is not really the cool company. And when you look at the number of mentions, and on this chart, you can tell by the size of the dot, people don't really talk about it that much compared to Carvana and even CarMax. But it's where you want it to be on this scatter plot. So to the right means higher increase in purchase intent, and towards the top means happier customers. So top right's where you want to be compared to your competitors. And so I really like AutoNation's positioning here. They've got a strong increase in purchase intent. They've got the highest happiness of the three, although it has come down over the last little bit. And you're right. I mean, used car prices in August were down 4%. They've been pulling back, but they were incredibly high before. So normally that's a depreciating asset. For a little while over the last 2 years, it was unbelievable territory where cars were appreciating, but that was because of demand. You couldn't get a new car, so everyone had to buy used cars. And you can see that prior to 2020, I mean, it was pretty consistent, pretty sideways, some fluctuations in there. But then we had a real big boom on used car demand. And of course, that threw up the prices. All these guys all the dealerships sitting on used cars were just, in heaven as their depreciating asset was all of a sudden appreciating. But there is some concerns with this market in general. Like you mentioned, the used car prices are coming down. People are getting a little bit tighter with their money. We've got people talking about being behind on their payments. That is up 117% year over year. So you get into that kind of situation, and a company like this that sells used cars, sells new cars, but also does financing is going to start to feel that a little bit. So we are concerned with that huge spike there. Not as big as 2020, as you can see in the chart, but still it's ramping up as the consumer is squeezed. So overall, I really like this company, especially in this space, because I think it does get overlooked. It's got a PE ratio of about 5, whereas CarMax is 15 and Carvana is losing money. So it is, it's priced right, I think, where it's at. And again, it's not the sexy name, but it does have a very strong revenue stream and a good positioning in the economy right now. So I like it, but there are some headwinds that we talked about.
Landon, 339 franchises on 247 stores. It's not a very big company, and it's got a very low stock float, only about 55 million shares. It sounds like to me when I'm reading, I don't see a lot of these in the Midwest. It's a lot of Sun Belt, and down south is where these companies seem to go. Is this just a factor of this is going to go with the car business, right? This is going to go with GM and Ford and Stellantis and all these other names. And it's had a pretty dramatic sell-off down to a pretty solid, if you look at support levels, it's getting pretty sold here. It's touching oversold levels. What is this? Should we trade this company just like the auto sector, or does it have any other qualities that we should be looking for?
Well, so it's about 43% new car sales, 36% used car sales, and the rest comes from finance, parts, service, and some rentals. So they picked up some rental car companies as well. So I don't think that they're going to go, parallel with Ford or GM, and I certainly don't think they're going to be exactly the same as Carvana or CarMax. I think they're kind of different. They're sort of, they're the value play when it comes to cars, and again, they don't have the same footprint that some of these others have. So they're meddling with new cars and used cars, and so I think they're going to be very susceptible to the fluctuations in used cars. If you think about, like, I looked at their balance sheet, they've got about 1.9 billion in inventory. Their market cap is 6 billion. So about a third of their market cap is inventory, which, generally speaking, is the depreciating asset. So they've got to continually move those. If the demand continues to rise, which it has, new car demand is up 8% year over year, used car demand is up 18% year over year. That's very good for this company. So I think that this company goes the way that the consumer goes on cars. And as long as there's trouble producing new cars, which we've seen, you guys were talking about NVIDIA, getting those chips out, getting chips in cars and just producing cars. As long as that's troubling for companies, then the used car demand is going to continue to go up, and they're in a good position to take advantage of that.
Yeah, and you mentioned, Kevin mentioned the geography. This is a smaller company compared to its peers, and it seems to be located in states that everybody's moving to, unlike us, Kev, where we live here.
Not yet, anyway.
Not yet, exactly. When you look at data, I mean, that's probably a boon for them. But then on the other side, with interest rates rising, 30-year mortgage up above 6% now, so financing starts to become more costly. So that pulls back on consumer demand somewhat. So you mentioned the inventories. When you look at all those data points that are out there, are they offset enough to provide maybe some support for a smaller niche player in this space where somebody like Carvana has been taking it on the chin? You mentioned, they've got those, basically vending machines, but the company's really struggling because they're losing money, a lot of debt on their balance sheet. But then CarMax, which is the behemoth in this space, they're in areas that, maybe people are moving out of. So do you look at all those data points to come up with maybe your sentiment on this?
Yeah, I mean, I agree completely about the interest rates. That's going up. It's going to make, it's going to make their financing department a little happier. They make a little more money there, but the demand is what's going to suffer. And they have far higher percentage of sales that come from actual selling of cars rather than financing. So I think they want lower interest rates. So, a year ago or maybe a year and a half ago was the Goldilocks zone for them. Everything was perfect, low interest rates and insane demand. That was an anomaly. And as you guys have mentioned, the stock is kind of sideways now, coming down to support. So I think they're back into realistic world. While the consumer demand for cars is increasing, I agree that the interest rates increasing is a little bit more concerning. But for me, if you look at, again, just the valuation of this company and the fact that they are, they're very solid, they're profitable, they're doing well, PE of 5. Their market cap is the same as Carvana, and one of the companies is making money. The other one is a moonshot that can't figure it out yet. So I think this, if it does pull back anymore, if it gets under 100 or high 90s, I think it's a safer long-term play. Plus, they've got the ability to expand. You mentioned how regional they are. They can go anywhere in the U.S. So they have the ability to expand. So maybe 5 or 10 years from now, this is going to be a company that you look back and say, wow, they were trading at around 100. That's crazy. Seems low. So I'm bullish on them long-term. Short-term, I think there's a lot going on with the economy, with interest rates and everything. But I do think that consumer demand is the main factor here. And right now, it's positive for AutoNation.
All right. Yeah, you mentioned the fact that near term, they've got earnings coming up in mid-October. That could be a catalyst. But the macro environment seems to be really affecting every stock that we talk about. So sentiment on this one pretty high as far as happiness and purchase intent also. So good look at that data. Appreciate it, Landon.
All right, guys. Thank you.
All right. That's Landon Swan, co-founder of LikeFolio, breaking down the data on the